Every investor loves a bull market. Almost everyone feels intelligent when prices are rising. But history shows something important. Real investors are not created during bull markets. They are created during bear markets. Every major financial crisis has asked the same question. Will you panic or will you stay disciplined? The answer to that question has separated successful investors from emotional investors for more than 100 years. Today you'll learn why markets crash, why fear spreads so quickly, how professional investors prepare for uncertainty, and why some of the greatest fortunes were built during periods of panic. Let's begin. A market crash is a rapid and significant decline in asset prices. A bear market generally refers to a prolonged decline, often defined as a drop of around 20% or more from recent highs. Crashes can happen suddenly. Bear markets often develop over months. Both create uncertainty, both create fear, but they are not identical. Understanding the difference helps investors react more thoughtfully instead of emotionally. Markets crash for many reasons: recessions, financial crises, high inflation, rising interest rates, geopolitical conflicts, unexpected shocks. Sometimes markets fall because expectations become unrealistic. Other times they fall because genuine risks emerge. The important lesson is this: no one can eliminate uncertainty, but every investor can prepare for it. Preparation creates resilience. Fear spreads faster than optimism. Imagine someone shouting "fire" inside a crowded theater. People react immediately. Financial markets often behave similarly. When prices begin falling, fear increases. Selling creates more selling. Negative headlines attract attention. Social media amplifies emotion. Eventually, many investors stop making rational decisions. They simply want the pain to end. Professional investors understand something important. Markets often become most emotional near extremes, and emotional markets frequently create extraordinary opportunities. History is filled with difficult periods. Yet history also shows something remarkable. Markets have repeatedly recovered over long periods. Recovery has never been guaranteed for every company, but diversified equity markets have historically experienced cycles of decline followed by recovery. Professional investors study history, not because history repeats perfectly, but because history teaches perspective. Perspective reduces panic. Professionals prepare before markets decline, not during the crisis. They ask, how much risk am I taking? Is my portfolio diversified? Do I have a plan? Can I survive a difficult year? Preparation creates confidence, and confidence supports disciplined decision-making. Cash often receives little attention during bull markets, but during bear markets, liquidity becomes valuable. Cash provides flexibility. It allows investors to respond to opportunities. Holding cash has trade-offs. Too much cash may reduce long-term growth. Too little cash may reduce flexibility. Professional investors think carefully about this balance. The biggest mistake is abandoning a thoughtful plan because emotions become overwhelming. Fear encourages investors to believe that today's conditions will last forever. History suggests otherwise. Markets change, economies evolve, businesses adapt. Professional investors remain flexible, but flexibility is different from panic. Great investors rarely celebrate market crashes, but they understand that lower prices can create opportunities if business quality remains strong, if financial health remains solid, if valuation becomes more attractive. Professional investors continue asking questions. Has the business changed, or has only the price changed? That distinction can be extremely important. When markets become emotional, written plans become valuable. A written investment plan reminds you why you invested, your objectives, your risk tolerance, your time horizon. Professionals rely on preparation instead of memory, because emotions influence memory. A written process helps maintain discipline during uncertainty. Every market decline teaches the same lesson. Risk cannot be eliminated, but it can be managed. Preparation cannot guarantee success, but it improves resilience. And resilience allows investors to remain in the game long enough to benefit from future opportunities. Research 3 historical bear markets. For each one, answer: what caused it? How long did it last? What happened afterward? What lessons can investors learn? History is one of the greatest teachers in finance. Study it carefully. Today you learned why markets crash, why fear spreads, how professionals prepare, and why discipline matters most during uncertainty. Tomorrow, we'll study one of the final skills, building a repeatable investment process. Subscribe to Wealth Entertainment 21. Turn on notifications. Anyone can stay confident when markets are rising. Character is revealed when markets are falling. Stay disciplined, stay prepared, and think long-term. I'll see you in episode 28.